Okay, great. Hopefully this is working for everybody. Thank you, Tony, for all of the ideas and unique format. I think it's going to be an exciting session, and I'm excited to do entrepreneurship stuff. So thank you everybody for joining us too, and special thanks to my co-authors who spent a lot of time helping me with this paper. That's Ofer Elder at Duke and Kate Waldock at Georgetown. So this is a paper and this is a session on entrepreneurship, but it's also closely tied to the corporate governance literature, and the paper's common ownership and startup growth. So to start the paper, the key hypothesis that we're working on is what is really this common ownership hypothesis? And typically economics starts from the premise that firms maximize profits. Of course, anybody who's taught either micro or corporate finance knows that you're going to get a smart student whenever you say that you should be, a firm makes a choice such that the marginal product capital equals the marginal cost. Some students naturally are going to object and say in real life, that's just not how decisions are made. And that sort of leads to the classic argument by Friedman that, yeah, we don't know exactly how firms make decisions, but if you look at it, they seem to act a lot like billiards players. That is, that we don't know every angle that's being put out there, and we don't know every example, but it seems like they're close to optimizing. If they're close to optimizing, then that means that, they are in fact optimizing. And who are they answering to? Well, they're answering to the investors. That's always been one of the big rationales, while investors would naturally select on them and say, no, we're not going to invest in this firm anymore. So what do investors really want? Some investors may hold stakes in you and your competitor. We'll call them common owners. And common owners may want to maximize the profits of all firms in their portfolio, not just an individual firm profit. While this seems like a simple idea, it actually has really, really big consequences if you think about it from a big picture perspective. If the common ownership hypothesis is true, that is that investors aren't encouraging firms to maximize individual profits, well, then you could have a lot of different outcomes. There was just the QJE that came out this week. It had the big paper that's on the macro implications of markups rising so substantially over the past 30 years. Well, what else has risen substantially? Common ownership. And sort of what we're going to focus on today is actually the potential.
Just one thing. Your screen seems to have stopped sharing, so you might want to.
Oh, it did?
Yeah. So just only reason to interrupt is to do that. Yes. Sorry.
Is it sharing now?
Yes, it is.
Okay. Cool. So what we're looking at and where I was at was the consequences of common ownership. And we're going to focus not on the sort of product market effect, which is the one that really looks at consumers. I think what we're going to focus on is the potential effect on firms. And why are we going to look at firms? Well, because the idea that, if investors are maximizing aggregate profits, it could actually compromise the outcome for individual firms. And this might be an important consequence to evaluate, especially from those who, think that exploiting information and hurting firms is not what we want to be having. So if investors are pushing for such outcomes, then, this common ownership could have a lot of big policy implications. For example, the need to regulate against conflicts of interest, which I'll talk about this in a little bit. That's our main identification. And also the need to examine mergers at the investor level for potential effects in the product market. So what are we doing in this paper? We're looking at the common ownership question, but instead of all the papers that have been written so far that have looked at public firms, we're going to look at entrepreneurial firms. Why do we think this is important? Well, because common ownerships of startups by VC firms is pervasive and it's increasingly consequential. So SoftBank and Sequoia Capital, very similar to BlackRock and Vanguard from the perspective that they're owning a lot of overlapping shares in or have big stakes in competing firms. What we think of is really nice about the VC setting is that you can contract on specific laws or rights. And so, unlike sort of the passive ownership stake where, there's many debates and questions in the common ownership literature, here there is much clearer potential channel for a mechanism of influence. That being said, common ownership has not even been considered in the VC literature. If you look at some of the big names who have written on this topic, Kerr, Lerner, and Shore in their 2014 RFS paper said one of the central and more enduring questions in entrepreneurial finance is to the extent a bunch of different factors, but what they say are all factors that relate to this firm as an individual. It's, are we looking at value-added services? What's the control right? Are there agency problems? Nothing about what they examine as this litany of factors says that there's, firms can interact with other firms. And so scrapping that view that firms are in isolation, especially entrepreneurial firms, then brings up a whole set of sort of interesting questions that we're hoping to address in this paper. And we can't answer obviously every question, so what we're going to start off with is just the basic one. Does common ownership happen? And if common ownership happens, is it good or bad for firms? So you might say, wait, I took IO. Common ownership clearly is going to be good for firms. And what we're going to say is no, it actually can be bad for firms. And this is the example of exploiting information. So a venture capital firm sits on the board of one company. Great, they get a ton of information about this startup. We know that you're invested in this particular industry. And so who's going to come? There's all these other, very hungry entrepreneurs who want capital are going to try and get VC funding from that same VC. Okay? Given that is going to happen, there might be opportunities where they can invest in another startup. Typically, this would have been something that would have been blocked or would have been a legal landmine, as sort of has been described. And there's a very good example from a recent court case where it was Alarm.com. Their investor in Alarm.com misappropriated information that was trade secrets, and they used it to invest in a competitor firm. This went to the courts, it went to Delaware Supreme Court, and what Delaware said is, no, you don't have a court case. Yes, these facts probably happened, but there was no conflict because you had basically signed what we're going to talk about, which is a corporate opportunity waiver. And this is something that basically prevented them from suing or going after somebody who misappropriated information. And so this obviously led to a bad outcome for Alarm.com, but this could be a more general phenomenon. On the good side, this is what we typically think of as the classic synergy gains. VC directors share information. They can, help facilitate deals. They can maybe allocate resources more efficiently. There's a lot of potential gains, and in particular, there's been a set of papers recently. There's a JPE that's forthcoming now, and then Juanita has a paper where they're looking at sort of innovation spillovers. So we think of that as probably the really positive channel through which there could be good outcomes for startups. So given that, few startups have products or even commercial success, we can't answer the welfare question. So I just want to be really clear that that is a limitation of our study. One, to this good versus bad for startups debate. And importantly, why this matters is that we do know that VC-backed startups disproportionately impact the economy. They're the ones that fuel economic growth. They're the ones that fuel productivity and wage gains. And so VC investment meaningfully shapes these outcomes, and thus we think it's an important question regardless of if we can go after consumer welfare. So what do we do to do this? We have a lot of steps that we have to take. The biggest one is developing a novel data set. State of incorporation, if anybody's ever done it for public firms, it's generally really bad. For private firms, imagine like a mess times 100. We looked at different data sets out there. There was no good data set with state of incorporation for private firms. So what we did was create a novel panel data set using LexisNexis filings. And so we have where you were incorporated and then in fact if you moved. This allows us to bring a new identification strategy. The identification strategy is that we use the staggered adoption of state laws that protect VC investors and their directors from liability risk if they pursue conflicting business opportunities. We use this as a shock to common ownership. And then we can focus on the mechanism. Our hypothesis is that it's going through directors. It seems like a sensible channel, yet it was not really, if you know the airline paper, they were saying it's a wink and a nod on analyst conference calls. This seems like a much more plausible mechanism where you are on the board, you're privy to private information, and you can there therefore share it with others. And then what we're going to evaluate is sort of financing outcomes to start with. So are they able to raise more financing? And if so, then we're going to finally go from there and look at the potential trade-offs. That is the good versus bad. We're going to look at the portfolio returns for VCs and then the probability of successful exits or failures. Is the startup getting killed off because you want to take that opportunity and put it in another firm, so that firm basically wins the startup lottery and you're going to get your 100x returns as a VC investor. So what are our main findings? First, we have evidence of a mechanism. We see that commonly held startups have more VC directors. They sit on more startup boards, including startups in the same industry. Then we look at the startups and we show that commonly held startups attract more VC investment in large volume and larger value, especially in later rounds. So this suggests that it's not just, some people had said, oh, common ownership is just this spray and pray phenomenon. You're going out, you're investing, and then you like double down on the good person. This is not what we're finding. We're finding that it's like really meaningfully is helping these firms continue to grow. And then the last one is we have a lot of suggestive evidence associated with informational efficiency. So we see a higher probability of IPOs. When we look at the IPO valuation relative to their public peers, these firms are IPOing at a better valuation, suggesting that they are good firms. It's not some mirage for the market. It's also that these startups have a higher probability of trade sale and uniquely an acquisition by a commonly held startup. That means somewhere and then finally we see a lower probability of failure. So if you think of this collectively, this is the idea that the distribution that we know for returns for startups is generally centered around 0, and then you have a long tail. What it seems like is happening is that the distribution is getting shifted at least a bit to the right and helping some of these less fortunate startups to survive. So there's a large literature. It relates to a bunch of different areas. So it relates to common ownership in public companies by really establishing this mechanism and sort of getting into it more. We're looking at the venture capital literature. There's been a lot of stuff about the importance of social ties in venture capital. This is further emphasizing that factor. And then it's also been looking at the big literature on directors and what is a good director. Is it a busy director? Maybe it's a director that sits on other companies' boards and those types of director characteristics. So to get into some of the institutional background, what is the corporate opportunity doctrine? Well, it prevents fiduciaries. So who are fiduciaries? Those are your board of directors. Those are your big owners. It prevents them from stealing a business opportunity that belongs to the corporation unless they disclose it first. Alarm.com case, you get information, private information from the board. Typically it would be a conflict of interest to go use that and make money off of it in your best interest. Well, now because you're signing this doctrine, that's no longer the case. You can totally go and sort of exploit this and use that information to your advantage. So this first time this happened was in Delaware in 2000. And since then, 9 states have adopted laws that permit firms incorporated in their jurisdiction to waive the doctrine. This was a paper written by Eric Talley at Columbia in the legal world, and he documents the sort of states that have done this. And so we're going to use this in a staggered diff and diff design. Why do we think this might matter? Well, we think it might matter because entrepreneurs typically have similar business ideas. People who have been ordering food from home lately, Blue Apron, HelloFresh, very similar business ideas. And by sort of classic book and surveys of entrepreneurs, there's many close substitutes. We know Google was not the first, search engine. Typically, they imitate rivals and then they use ideas that are unprotected. Okay, so we think that there's clearly a potential for there to be room for stealing ideas, room for getting advantage. So why the corporate opportunity waiver? Well, it's actually now standard practice. If you were a company and a founder and you were going online and you were downloading, the form to start a business, you would have the corporate opportunity waiver in your charter to start with. Okay, waivers of the corporate opportunity doctrine, they help to dissuade private equity investors whose board seats would come with fiduciary duties from, you know, not investing. That's why they need the waiver. And more generally, you know, more board seats mean more problems. Typically, these GPs were unwilling to serve on multiple portfolio companies because they didn't want to have to deal with all of this liability risk. Now you've basically erased the liability risk for them. There's many examples of startups with the waivers, and there does not seem to be very industry specific. It's across the board. So evidence that the waivers do lead to information leakages. So this was the alarm.com case I was talking about. The facts of the case were that the company alleged that the PE firm had misappropriated confidential information, acquired through its representative service on the board, and then they used that information to invest in a competing company. And then this is where the Chancery Court dismissed the claim, saying that you had a waiver, therefore you can't actually sue. So anecdotally, do we think it actually happens? Well, this was a great example. Lyft and Uber actually share common board members currently. They did at earlier stages as well. And this was a podcast right before Lyft's IPO. And the quote from the podcast is that in markets with two players, often you have a shareholder or two that's common to both companies. When that's not the case, competition will be higher. So this is clearly a big, you know, guy who's a pre-IPO investor in both Lyft and Uber, works for a VC fund, said, nope, competition would be higher if it weren't for common ownership. Okay, do common owners influence, though, their firms they invest in? Are they influencing them in a deliberate way? So this is, again, an example about Uber, but you can find other examples. So The Economist on SoftBank, Uber and Didi. In the near term, the focus is on encouraging the ride-hailing firms to compete less feverishly and rather to push up fares. He called for Uber to concentrate on its core markets, and then Europe and Australia were gonna, basically Didi was gonna take a stake in certain markets and Uber was gonna focus on that. What happens? Well, they came to this agreement, and then we see ride fares go up, driver compensation go down, and ultimately this meant a big increase in margins for the companies. It was a big success for the owners. So I think there's sort of anecdotally evidence of this. It seems like it's potentially a relevant factor for startup growth. But again, if you go back to the original economic tension and insights, it's unclear if it's good or bad. And there's some ways where, like, yeah, you're exploiting this information, you're going to steal it, it's totally bad. There's the other side where there's synergy gains. Is that the dominant mechanism? We don't really know. And so this is why we need the empirical tests. So what do? We start with data. Our data is at the level of a VC startup in a given year. We get information on the VC, the startup, the directors of that startup, and then we match this with other data sources. So what we really want to know is these outcomes. And then in particular, what we want to know is if the startups are able to be successful. So we're looking at things like IPOs, we're looking at things like additional financing rounds, etc. So just to show you in the summary statistics between treated and control, even without other factors, you see between the treated and control that there's higher levels of common ownership in treated firms. There is more VC investment in treated firms. There's greater numbers of VC directors, and especially VC directors with additional directorships, okay? And then what we start to see is these outcomes do seem to have differential effects. Okay, what is the difference in difference test? Well, I don't know. I've gotten into the factor of loving to build appendixes, but we run a bunch of different tests. We ran it 5 different ways. Really, whatever way you want it, I can run it that way. We start with just the basic of saying, you know, we're not even going to put in all these fixed effects. We're just going to look at a treat and a treat times post. Then we add the startup fixed effects. Later, we're going to add a control for 5 years after treatment. Why do we add that control? Well, we want to know that this is not a reversing effect. It's not something that's mean reverting, that we're just catching some anomaly. We add headquarter location. So this is really important. This is saying, I have a startup, 2 startups in California, one of them's headquartered, they're both headquartered there, but one's incorporated in Delaware and one's incorporated in California. That's essentially the variation that we're using. So you're getting rid of these local economic spillovers. We're just looking at that state of incorporation difference. And then we have industry by year fixed effects, which are putting another layer on top of that. Standard errors are clustered by state of incorporation because that's our level of treatment. We also run an instrumental variable test. This was one of our facilitators' comments. So our reason for doing this is intent to treat versus a direct effect. So when you're looking at the difference in difference, again, because it's the law change, it's really what you're estimating is the average intent to treat. So we can see that common ownership changes, but if we were to go to the next step and look at the effects on firm outcomes, we don't really know if that was happening through that channel or potentially other related channels, okay? Whereas, using this IV setup and what we're doing here is we're taking a direct measure of common ownership. And then we're using as our IV, basically, are you in a state that's treated? It's very similar type of shot, similar comparison of firms. What you're really getting is this, when we put in the fixed effects, you're getting the 2 California firms, one incorporated in Delaware, one incorporated in California. But you're now saying, okay, I know increasing common ownership is going to be associated with that. So that was our main reason for using an IV specification as well. In the appendix, we put both ways for those who might just say, look, I think it's cleaner to look at this intent to treat. So what do we find? Yay, finally getting to the results. So we see that common ownership increases. For here, I'm putting our most stringent specification. So this is the one with all the fixed effects, but it's the same regardless of what you look at. What this is showing you is that treated startups are about 8 percentage points more likely to have a common owner, which is about a 30% increase in total common owners after the law change. And we look at the coefficients on post 5 years, it rejects the hypothesis of mean reversion. So it's clearly an increase in common ownership. So this is looking at the dynamic effects. So this is saying, what do we think that the trends are looking like? Are there parallel trends? And so what we see is it's relatively flat in the 5 years beforehand. In the 5 years after, there's a clear jump up and an increase. So this suggests that the straight lines in this graph, so this is the black line is relative to the treatment year. The treatment effect is any common ownership. And what we're looking at in the straight lines are the 90% confidence intervals. This is from the regression with startup and year fixed effects. And what this figure suggests is that there's really just no pre-existing differential trends. We probe this much further in other pictures, but it's giving you some confidence to start with. Anybody who knows the law literature knows Delaware is really important. Delaware is important for everything. So we are just really upfront about it, and we look at it and we say, maybe this is weird factor about states. So our first test of even looking more at the common ownership is to look at high entrepreneurship states. So we limit our sample to California, Delaware, Maine, and New York, or Massachusetts and New York. This makes up a large portion of our sample. If you see, it's 111,000 observations, where our main sample was 128. So most firms or most startups are in these states, and we see the effects still here. And then finally, we go to states that are not originally incorporated in Delaware, startups not originally incorporated in Delaware, and we see the effect happens there too. So this is not just a Delaware effect for those who might be concerned with that part of the story. Next, we look at it from a little bit different perspective. So we've shown common ownership, but there might be a concern that, oh, this is just coming from different types of investment. So here, what we're looking at is investment on the extensive margin. Are you investing in another firm in the same industry, or do you already have 2 firm investments in one industry and you're just doubling down? And so what we're seeing is that you're clearly increasing same industry investment, and then it's mostly 75% of it is coming from the intensive margin, 25% from the extensive margin. So you're probably doubling down. In some cases, you are also investing in another firm. Next, we turn to the economic mechanism. So this is the first result that's really brings something different than the public company literature, and that is we're showing that there is an increase in overlapping directors. Okay, we show that these VC directors sit on boards at 2.8 additional startups. And then if you look at it within industry, so this is saying, you know, are you Uber and sitting on Lyft? Within like small industry categories, what we're seeing is you are sitting on another startup board within industry. We've also have similar measures when we look at the tests for different measures of common ownership. Right now, I'm just reporting the simple any common owner measure, which is an indicator variable for that. We've looked at stuff as advanced as the GGL method, which is the Gormley, Gilgy, and bad on names, but it's GGL. So we've looked at that. It sort of goes through, but it's in our setting, we think the simple is probably the best way to go forward. And then we'll show you here, you're seeing there's a strong first stage. We report the first stage statistics, but it wouldn't be surprising given that we saw the diff and diff results that, you know, we have a large F stat and the T stat is over 12 on the instrument. So it suggests that, you know, we shouldn't think of it as a weak instrument, that these results seem plausible and probably are not getting overly inflated because of the estimation method. So then we go from there to startup growth. So startups with a common VC owner raise more capital. That's pretty exciting. That means it's good, potentially. We see it both in volume and value, and we see it in later rounds. So that's really cool. So it's not just that, like, look, we can be common owners right away and then, you know, go somewhere else and pick on one or hurt the other firm. It seems like even later rounds, we're investing more in each of these startups. So they're able to grow, and that's exciting. And these results are similar also if we were to use the diff and diff specification. So to think about some of the robustness, this is where, you know, the love of the appendixes come in. If we use this GGL measure, our results are similar. Similar results when we exclude Delaware. For those who are really concerned about Delaware and concerned about this whole effect, what we did was a matching estimator, and we basically took, you know, sort of the full gamut. We did nearest neighbors, we did different numbers of matches. We created an index that helped us evaluate what are the best matches, and the factors that we were matching on were age, capital raised, industry, and year prior to this. So this reduces our sample, I would say that. You know, you might not think that all startups are the same or, you know, equally likely to get a common owner. Well, even when we do this matching estimator sample and then we run it on both the, you know, we use the matching estimator, but then we use the reduced sample and run our standard methods. In both cases, the results go through. So this is really convincing to us that, you know, it's not something about the startups that we're, you know, missing. We really think this is happening. Then we exclude the .com bubble years. This is basically then that's excluding the Delaware because Delaware was right near that. I think this is Mike's paper. The spray and pray investments, so it was the software companies. So we basically take out, we look at different cuts of the samples. We look at software companies post 2006, sort of when the advent of Amazon Web Services came about. So it made it a lot cheaper to have a startup. And, you know, we saw that the VC investors changed behavior and strategy after that. We show that our sample or our results are robust to that sample as well as the sample that excludes them. So it doesn't seem to be a factor that's coming from that. We look at the broader exemptions from the duty of loyalty. This is that there is some nuance in the law. There's always nuance in the law. And so we look at different states where, you know, you could interpret the law a little bit differently. And we see patterns consistent with, you know, and there was weaker results in the state where, you know, these conflicts of interest are not sure to go through. Finally, for those still concerned about Delaware, despite the matching and despite the different challenges, we look at a totally different setup. Mind you, this setup also has its own caveats. It's LLCs. There's a bunch of work in the public economics literature about taxes. Certainly had John Graham drill this one home in my head, but we look at this sample and we say, you know, there are some LLCs, about 3% of startups are LLCs, and so we just use a single diff methodology. We're just using the date of Delaware. The reason we're doing this is because firms can reincorporate into Delaware, and we're saying, if we use this single diff and diff, does it go through? And our results do go through. Of course, you could say choosing to be an LLC versus choosing to be a corporation is, you know, clearly makes you different. But I think it's like comforting to know that even in a totally different control group, there seems to be an effect there. And then the final thing we do is we review the legislative hearings before the legal changes. This is consistent with the Jonathan Karpov literature, and more generally just the natural experiment literature. Is you want a natural experiment to be something that was not forecasted or lobbied for by firms. And what's really nice about ours was when you look at it, the Delaware change, it occurred because they were trying to eliminate uncertainty regarding a corporate opportunity arising from a 1989 case. So when legal uncertainty is being clarified, that's like the best type that you could have in terms of natural experiment. You're getting that, and then each of these other states that did it, they often do it because they mimic Delaware law. And then we finally had New Jersey and Washington, which were two of the states that were later to do it, and they were the only ones who even had any reference to sort of startups. And what was interesting was it was not the firms advocating for it, it was actually the lawyers saying, we're losing business, please change the law so we can get business back. So this really suggests that, like, as a whole, it's a really nice natural experiment that could potentially be used in other settings. So let's get into
we're actually maybe 1 minute to wrap up.
Oh, really?
Yeah,
okay.
Yeah.
So I'll go to the real effects. The real effects are probably some of the best results, so I will move to those. And that has to do with the startup exits. So we see basically good things happening. You're IPOing at a higher rate, you're merging, you're going through a trade sale, you're less likely to fail. Those are all good things. And the one that we think is most consistent with synergy gains is this idea where there's acquisitions by commonly held startups. So we're seeing a higher held startup. So this is suggestive of information sharing, but you wouldn't be acquired unless it was a beneficial thing. This is Gomper's paper, although I know Song has a paper that is sort of different in a different industry, and I'm happy to talk about that too. And I think the last thing is when we look at the IPOs, these seem to be IPO firms that are generally more successful than their public peers, suggesting that it wasn't some problem with the firm. So in conclusion, common ownership by VC investors is pervasive and consequential. We should think of it as an important factor. We should also think that VC firms appoint their directors to sit on competing startups. This overlapping directorship is much more common than you would have thought, and common ownership is associated with benefits to these startup firms. VC investment grows, but also there's higher IPO valuations, more trade sales, and fewer failures. So thank you, Tony, and thank you, everybody. I'm looking forward to questions.